Today I want to talk about the use of SRS, also known as your Supplementary Retirement Scheme, as an instrument to help you lower your taxable income. For those who are not familiar with the use of SRS, it is basically a voluntary scheme to encourage individuals to save for their retirement. You can create an SRS account with either your DBS, UOB or OCBC, and on a yearly basis, you can contribute up to about $15,000 for Singaporean and PR, and up to $35,000 for foreigners. So how does it work? And why would anyone bother to contribute to their SRS account? The incentive of contributing to your SRS account is that for every dollar that you contribute into the account, you get to reduce $1 on your taxable income that given year. Right? In terms of the technicalities behind it, you're not avoiding the tax completely, but you are merely deferring your income to a later date of which you'll be taxed at a concessionary rate after your retirement age, right? When you withdraw your SRS savings upon retirement age, only 50% of the SRS savings that was withdrawn will be added into your taxable income at that given year, of which you'll be taxed based on the respective tax bracket you are then. Now moving on, let me run you through as to why you should open your SRS account as soon as possible. Right? In terms of the withdrawals, bear in mind that you can only withdraw your SRS savings after the retirement age, which is based on the prevailing retirement age when you open your account. That means that if you open your SRS account when the retirement age was 62 years old, you can start withdrawing your SRS savings at the age of 62. Okay? If you open your SRS account when the retirement age is 65, you can only start withdrawing at the age of 65. What this means is that the earlier you open your SRS account, the better it is for you, as you are essentially locking in based on the prevailing retirement age, which is only set to increase in the future, right? With regards to how the SRS withdrawal works after your retirement age, upon reaching the retirement age itself, you are given 10 years to withdraw your SRS savings, of which 50% of the amount that's withdrawn will be added to your prevailing income on that given year and taxed accordingly. Okay? For example, if I were to withdraw $100,000 of my SRS savings in the first year, $50,000 will be added to my taxable income in that year, of which I will be subjected to taxes based on my prevailing tax bracket then. That also means to say that if you want your SRS savings to be 100% tax-free, you can only withdraw up to 40K a year, provided that you don't have any income after the retirement age. That means that essentially only the first $400,000 of your SRS savings can be tax-free. Okay? So what happens after the 10 year of the withdrawals that we are permitted to have, right? For any amount that is not withdrawn after the 10 year, 50% of the remaining balance will be subjected to income tax all at one go. Essentially, what that means is that the objective of your SRS gaming, right, is to ensure that your balance will not exceed about 440K after your retirement age to ensure a complete tax-free withdrawals. You will also want to reduce the amount of balance that's left after 10 years because everything will be taxed at one shot. Okay, so for withdrawals that happens before retirement age, right, you will be subjected to a 5% penalty for premature withdrawals, and 100% of whatever that you withdraw will be added to your taxable income that year, which may screw up your tax bracket in a given year. Now, for those who are sharp, suffering a 5% penalty, right, might be worth it if you know how to time and plan your withdrawals accordingly based on your outstanding income at that given year, right? Because if your tax bracket were to be at like 20%, 5% penalty is really nothing much to you, right? Now, this penalty shall not apply only under certain circumstances like death, medical grounds, bankruptcy, or even withdrawals in full by foreigners, subjected to specific terms and conditions. Now, a little bit of caution with regards to the use of SRS. All in all, when it comes to the use of SRS as a tax savings instrument, you need to be able to plan properly, as the taxes that you save today might not be worth the taxes that you may incur in the future, as essentially you're just deferring the income to a later date and you're not escaping taxes completely. Remember, only the first $440,000 can be tax-free, provided that you have no income at all from the age of your retirement. Another thing that a lot of people may have missed is that the taxes are calculated based on the withdrawals, not the amount contributed. So what this means, right, is that if, let's say, I were to contribute $200,000 into my SRS account, and I use this $200,000 to invest, which is what everybody will do, right? Because the default savings rates of your SRS account is 0.05%. It is negligible, right? If I use this contribution that I've made to my SRS account and I go and invest, that contribution, right? For example, let's say $200,000 of contribution may have grown to $800,000 at retirement age, because we've got like what, 20, 30, 40 years ahead of us to invest, right? So what this means is that the 600K of investment profits, right, will be considered as an SRS withdrawal when you withdraw, okay? And it will be added to your taxable income then and taxed accordingly. Let that sink in a moment. In other words, right, even though investment returns, be it capital gains or dividends, are not taxable in Singapore, if you were to invest using your SRS and withdraw from the account after your retirement age, whatever returns that you may have made will be taxed based on your prevailing income tax bracket, which essentially you're indirectly exposing yourself to additional taxes, which under normal circumstances is not taxable on your investments. Okay. Personally, I am not a huge fan of SRS, as like I said, you're directly or rather indirectly subjecting yourself to taxes on your investment gains, which under normal circumstances are not taxable. The use of SRS is actually viable if you know how to plan properly and invest accordingly to ensure that the total SRS contribution and your potential investment returns will not exceed $440,000 at your retirement age, right? So that all your withdrawals can be tax-free. That is how you make full use of the SRS account, okay? SRS account is also a viable instrument if your tax bracket is very high, right? Because the trade-off that you will suffer from is actually lower, given that you are subjected to a high level of taxes or higher level of tax bracket, right? For most people out there, I would still prioritize the use of voluntary CPF contribution as the primary tax saving instruments before you even consider the use of SRS as a secondary potential tax saving instrument, right? All in all, for SRS to be a viable tax saving instrument, you really need to plan properly. I cannot stress how important this point is, right? With an investment duration of 20 to 30 years, right, it is really very easy for your contribution to cross the tax-free balance of $440,000. Right? And what this means is that if you don't plan properly and you screw up your SRS contribution, there is a good to fair chance that you may be subjected to higher taxes at a later date, which could easily overwhelm the tax savings that you may have today, henceforth defeating the entire purpose of the use of SRS as a tax savings instrument in the first place. Okay, so that's all I have for the video today. If you'd like to find out how you can benefit by working with an independent financial advisor and a certified financial planner, you can reach out to me via my website. Do connect with me on the social media platform as well to stay updated with future content, and you can also slide into my DMs anytime if you have any questions. I'll be happy to help. Now, all these links that you've seen on the screen will be in the description below. So yeah, I hope to connect with you all soon.